Welcome back to the channel. Today, we're diving deep into one of the most powerful business books ever written, The Innovator's Dilemma by Clayton M. Christensen. This book completely changed how we understand business success and failure. It shows that sometimes doing everything right is exactly what leads great companies to fail. By the end of this video, you'll understand why good companies collapse even with great leadership. The book's core vocabulary, every important term clearly defined. Real examples from Christensen's case studies, how the innovator's dilemma appears in modern industries. Section 1. The Big Idea. Christensen's main argument: companies fail not because they make bad decisions, but because they make good decisions in the wrong context. Most firms chase what's called sustaining innovation. That means they improve existing products for their most profitable customers. Meanwhile, small startups focus on simpler, cheaper innovations that established companies overlook. Those smaller products, called disruptive innovations, start weak, but they get better. And by the time big companies notice, the disruptors have taken over the market. That's the innovator's dilemma. Should you keep perfecting what already works, or risk everything on something new that could replace you? Section 2. The Vocabulary of Disruption. Let's go through the full list of important vocabulary terms from the book, each one defined and explained with examples. Disruptive innovation. Definition: a new product, service, or business model that starts in a niche or low-end market and eventually displaces established competitors. Example: early personal computers disrupted mainframe computers by being cheaper and more accessible. Why it matters. Disruption rarely starts by beating the incumbent on performance. It wins by serving ignored customers in new ways. Sustaining innovation as definition: incremental or continuous improvement to existing products that serve current customers better. Example: adding more megapixels to a digital camera or increasing battery life on a smartphone. Why it matters. Sustaining innovation keeps a business healthy short-term, but can blind it to long-term disruption. Performance trajectory. Definition: the rate at which a technology or product improves over time compared with the rate at which customers' needs change. Example: computer chips improve faster than most users need. That's a performance overshoot. Why it matters. When performance exceeds what customers require, the door opens for simpler, cheaper options. Overshoot/overserved customers. Definition: a situation where products offer more features or performance than customers can use or are willing to pay for. Example: modern smartphones already have camera quality far beyond most users' needs. Why it matters. Overshoot creates space for disruptors who focus on affordability and simplicity instead. The value network. Definition: the ecosystem of suppliers, distributors, customers, and profit models that define how a company creates value. Example: traditional car makers rely on dealerships and gasoline infrastructure. Their value network makes electric cars hard to adopt quickly. Why it matters. Disruptive ideas often need entirely new value networks to thrive. Low-end disruption definition: when a new entrant targets the least profitable or least demanding customers with a good enough product. Example: discount airlines like Southwest or Ryanair starting with no-frills, low-fare flights. Why it matters. Low-end disruptors begin small but climb upward as quality improves. New market disruption definition: When a company creates an entirely new market by serving people who previously had no access to the product or service. Example, the smartphone created a computing market for billions who never owned PCs. Why it matters. New market disruptors don't steal customers. They make new ones. Technology S-curve. A graph showing how a technology's performance improves slowly at first, then rapidly, then plateaus. Example, early digital cameras had low resolution, bottom of the curve, but improved exponentially before hitting limits. Why it matters. Disruptors often ride the early steep part of a new S-curve while incumbents sit on a flattening old one. Innovator's dilemma? Definition, the paradox that companies fail because the very practices that make them successful, listening to customers, focusing on margins, improving quality, also cause them to miss disruptive innovations. Example, Kodak followed customer demand for film even as digital photography emerged. Cannibalization definition. When a company's new product eats into sales of its existing products. Example, Apple released the iPhone knowing it would cannibalize iPod sales, but that move saved the company long term. Why it matters. Christensen warned that fear of cannibalization traps companies in the past. Incumbent versus entrant. Definition. An incumbent is the established leader in a market. An entrant is a new competitor introducing a disruptive innovation. Example, Blockbuster was the incumbent, Netflix was the entrant. Why it matters. Incumbents have resources but rigidity. Entrants have freedom but risk. Resource dependence definition. The idea that a company's strategy depends on the sources of its current revenue, especially its biggest customers. Why it matters. This dependency discourages investment in unproven markets where those customers don't exist yet. Fail small, fail often. Definition. Christensen's advice to experiment through small, low-cost trials, learn from failure, and iterate quickly. Why it matters. Small failures produce big learning. They help companies adapt before a large-scale disruption occurs. Section 3. Case Studies from the Innovator's Dilemma. The disk drive industry, the classic example of disruption. When Christensen first studied technological change, he focused on the hard disk drive industry, one of the fastest-moving sectors in history. In the 1960s and 70s, computer makers demanded ever larger and faster drives. Established manufacturers such as IBM and Control Data Corporation delivered exactly that. Huge, expensive 14-inch disks engineered for mainframes. Then smaller entrants, names few remember today, introduced 8-inch drives. They had lower storage capacity and slower performance. So the big computer firms ignored them. But those 8-inch drives fit a new product category, the mini-computer. As mini-computers grew, new entrants gained market share. The same cycle repeated again. 8-inch drives gave way to 5.2 5-inch drives for desktop PCs, then 3.5-inch drives for laptops, and later 2.5-inch for portables. Each generation began as an inferior alternative that incumbents dismissed. Lesson: disruption often enters where the incumbent's customers don't exist yet. By the time those new markets mature, it's too late for the giants to pivot. Mechanical versus hydraulic excavators. The power of simplicity. Christensen wanted to prove disruption wasn't just about high tech. He looked at construction equipment. Traditional excavators used steel cables and clutches. They were massive, powerful, and expensive, perfect for large contractors. Then along came hydraulic excavators. At first, hydraulics were weak and imprecise. Operators who needed heavy digging laughed at them, but they were cheaper, easier to maintain, and required less skill to operate. A great fit for smaller jobs and emerging markets. As hydraulic systems improved, they began handling the heavy work once reserved for cable machines. By the 1980s, hydraulics had completely taken over the industry, driving former leaders into bankruptcy or merger. Lesson: a simpler, cheaper technology that starts beneath an incumbent's customers can rise to redefine an entire market. Retail disruption. Department stores versus discounters. Retail provides one of the clearest illustrations of low-end disruption. In the mid-20th century, department stores ruled American shopping. They offered elegant settings, wide selection, and personalized service at a premium price. Then came discount retailers, Kmart, Target, and later Walmart. They targeted rural or price-sensitive shoppers who couldn't afford department store prices. The margins were razor-thin, and established retailers dismissed them as low-end operations. But discounters refined their supply chains, improved quality, and scaled nationally. Soon their stores weren't just cheaper, they were good enough for middle-class families. Department stores, bound by high overhead and brand expectations, couldn't follow without destroying their own model. Lesson: low-end disruptors climb the value ladder until good enough becomes the new standard. Automotive evolution. Toyota and the American Big Three. Although Christensen only touched briefly on automobiles, his later writings echoed this pattern. In the 1960s, U.S. automakers, GM, Ford, and Chrysler, focused on large, profitable vehicles for domestic buyers. Toyota, entering from Japan, began with small, fuel-efficient cars, cheap, simple, and initially lower quality. These cars appealed to buyers the Big Three ignored. Over time, Toyota improved reliability and manufacturing precision, eventually surpassing Detroit in quality and efficiency. Lesson: disruption can come from abroad or from new cost structures, not just new technology. Mini mills in the steel industry. Learning from the low-end one of Christensen's favorite later examples was Nucor Steel. Traditional steel makers produced every product, from rebar to sheet metal, inside massive integrated mills. Nucor began with mini mills that melted scrap metal using electric furnaces. Initially, mini mills could only make low-grade rebar, a cheap product incumbents were happy to abandon. But as technology advanced, mini mills improved quality and cost efficiency, moving step by step into higher-value steel segments. Eventually, they captured the entire industry. Lesson: when incumbents retreat upmarket to protect margins, they unintentionally hand over the base of the pyramid to disruptors who keep climbing. Connecting the patterns. Across these stories, from disk drives to steel to retail, the same pattern repeats. A simpler or cheaper innovation appears. It serves a neglected customer segment or new market. Incumbents ignore or abandon it because margins are small. The innovation improves faster than expected. The new players invade the mainstream, and the old leaders vanish. These industries may differ, but the logic of disruption is universal. Christensen's genius wasn't predicting the future. It was teaching us how to see it unfolding in real time. Section 4. Why Good Firms Fail. The Paradox of Good Management. Christensen begins this section with a statement that feels almost heretical in business school. Good management is the root cause of the innovator's dilemma. Companies stumble because they're well run. They listen to customers, pursue higher margins, invest in proven technologies, and reward efficiency. These same instincts, though, become barriers when a disruptive innovation appears that doesn't fit the old metrics. Managers aren't blind or lazy, they're logical. Their decision systems simply optimize for the wrong future. Force 1. Resource dependence. Follow the money. Firms allocate capital and talent toward the opportunities their current customers value. That's called resource dependence. When a disruptive idea surfaces, say, a cheaper, lower performance version of a core product, it doesn't look attractive to the biggest clients or shareholders. Internal review meetings quickly shut it down. Our customers aren't asking for this. Example, mainframe computer makers ignored personal computers because their enterprise customers wanted power and reliability, not affordability. Result, no resources flow to the small emerging market, and a startup steps in instead. Force 2. The value network. Trap. Every firm operates within a value network, its ecosystem of suppliers, distributors, partners, and pricing models. That network defines what makes sense financially. Disruptive technologies often require an entirely different network, smaller suppliers, lower price points, different margins. To adopt them, an incumbent would have to break its own ecosystem. Example, film companies like Kodak relied on photo paper sales and chemical processing. Digital photography required a totally new network, sensors, software, and online sharing, which didn't fit Kodak's profit logic. So the firm's internal compass, calibrated for the old world, keeps pointing the wrong direction. Force 3. Performance overshoot and customer focus. As products improve, they eventually overshoot what average customers need. A laptop that's 40% faster may not change the user's experience, yet costs more to make. This overserving creates a gap at the low end of the market. A disruptor steps in with a good enough solution that's cheaper and simpler. Once they gain traction, they improve faster than incumbents can react. Example, digital cameras started below the quality of 35mm film. By the time they matched it, Kodak's customer base had already migrated online. Force 4. The metrics problem. Corporations measure success using familiar metrics, ROI, net margin, payback period. Disruptive innovations almost always score poorly on those yardsticks in their infancy. A project manager who proposes one risks being told, "It doesn't meet our hurdle rate." Christensen calls this the innovator's filter. Good ideas die not because they're bad, but because they don't fit the spreadsheet. Startups, on the other hand, use learning metrics, market validation, engagement, iteration speed, which reward discovery instead of predictability. Force 5. Structural inertia and cultural lock-in. Large firms develop layers of process meant to protect quality and consistency. Those same layers slow down experimentation. Even when executives see disruption coming, their organizations can't turn quickly enough. Middle managers protect budgets, legal teams limit risk, and engineers stay inside established specs. Example, Nokia saw the smartphone wave but couldn't reorganize its product cycles fast enough to compete with Apple's integrated model. Christensen's advice, build autonomous teams or spin-offs free from the parent company's culture to pursue disruptive ideas. Force 6. Fear of cannibalization. Perhaps the most human reason: leaders don't want to destroy the thing that feeds them. Launching a cheaper product can undercut a profitable flagship, but in trying to protect short-term revenue, they sacrifice long-term survival. Example: Blockbuster avoided launching a robust streaming platform because it threatened in-store rental revenue. Netflix, with nothing to lose, embraced the model fully. Christensen's line still echoes today: "If you don't cannibalize yourself, someone else will." Pulling it together, the 6 forces at work. 1. Resource dependence makes managers chase today's profits. 2. Value networks anchor firms to old ecosystems. 3. Performance overshoot opens the door for simpler products. 4. Flawed metrics reject early innovation. 5. Cultural inertia prevents adaptation. 6. Fear of cannibalization traps success in its own shadow. Together, they create a near-perfect system for missing the next wave. Modern reflection. In today's world, these same dynamics play out in real time. Automakers struggle to shift resources from combustion engines to electric vehicles. Streaming services hesitate to pivot away from expensive content models toward user-generated ecosystems. AI incumbents balance their profitable enterprise tools against free open-source models that could undercut them. Christensen's insight remains timeless. The processes and values that make organizations strong in one era can make them fail in the next. Section 5. Failing small and failing often. Learning as strategy. The philosophy of small failures. After identifying why good firms fail, Christensen turned his attention to how they could learn to succeed again. His answer was simple but radical. The only way to test the future is to build it in miniature. Traditional managers treat failure as something to avoid. Christensen reframed it as an essential feedback mechanism, a laboratory for discovery. He argued that successful innovators don't predict the right path. They learn their way to it through a series of controlled, recoverable experiments. This is the heart of his principle: fail small and fail often. Fail small. Experiment before you scale. Failing small means keeping your experiments cheap, fast, and limited in scope. Instead of betting the company on a massive new initiative, you test hypotheses through small pilots, prototypes, or local launches. When something doesn't work, the cost of being wrong stays manageable, but the lessons learned are enormous. Example: Christensen and Rayner, the Innovator solution. Hewlett-Packard tested new printer technologies in small markets before committing globally, allowing teams to discover which features customers actually valued. Failing small creates a cycle of learning. Form a hypothesis about customer needs. Test cheaply and quickly. Capture insights without betting the whole business. Scale only what works. It's the same logic behind modern concepts like minimum viable products and A/B testing, which trace their philosophical roots to Christensen's framework. Fail often, iterate, and learn relentlessly. The second half of his message is to fail often. Innovation rarely succeeds on the first try. Every attempt generates new information about customers, markets, and technology. Frequent, low-stakes failure keeps an organization nimble. It trains employees to adapt rather than defend old assumptions. Quote from Christensen: "Each failure is not a waste, but a tuition payment for understanding a new market." This approach contrasts with the incumbent mindset of avoiding risk at all costs. When a company only permits big bets, the fear of being wrong stifles creative thinking. Christensen suggests managers adopt discovery-driven planning, an approach where assumptions are tested iteratively instead of being treated as facts. Designing for learning instead of perfection. To make this work in practice, Christensen outlined 3 organizational habits. 1. Encourage exploration units. Create small autonomous teams with their own budgets and freedom to experiment without traditional ROI pressures. 2. Reward learning, not just success. In a learning organization, a project that fails but reveals why customers behave a certain way is still a win. 3. Document and share lessons openly. When failure is hidden, the organization pays tuition for the same lesson twice. This approach reduces organizational fragility and creates an environment where employees take smart, contained risks. Historical examples of failing small and learning big. Honda Motor Company entered the U.S. with small motorbikes like the Super Cub after its large bike strategy failed. The failure revealed a massive market for light, affordable transport. Intel abandoned its memory chip business after experiments showed microprocessors had far greater potential. Its small test runs led to a strategic pivot that defined the company. 3M famously encourages employees to spend 15% of their time on unplanned projects. Post-it notes emerged from what was initially a failed adhesive experiment. Lesson: each failure was a signal, not a setback. Modern applications of Christensen's principle. Amazon treats failed experiments as the price of innovation. Jeff Bezos once said, "If you double the number of experiments you do per year, you're going to double your invention output." Tesla launches features in beta to learn from user feedback in real time instead of waiting for perfection. Google X uses what it calls kill criteria. If an experiment fails a key assumption, it's terminated quickly and publicly, celebrating the learning rather than the loss. These companies operate exactly as Christensen prescribed, failing in controlled, repeatable ways to accelerate learning. Cultural shifts required. Implementing this philosophy isn't just a process change, it's a cultural one. Leaders must model humility and curiosity, 2 traits Christensen believed were foundational to sustainable innovation. A manager who can say, "I don't know yet, but we'll learn fast," creates psychological safety for teams to experiment. Without that safety, fear of failure breeds stagnation. Fail fast versus fail smart. Christensen warned that fail fast shouldn't mean recklessness. Fail smart means designing experiments with a clear learning objective and controlled risk. The goal is to build organizational knowledge, not just break things for speed. Each iteration should reduce uncertainty and improve judgment. Christensen's final reflection. Later in life, Christensen tied this philosophy back to leadership ethics in How Will You Measure Your Life? He argued that growth, personal or organizational, comes from learning, and learning comes from failure. The key is not to avoid mistakes, but to make them small, frequent, and instructive. Our greatest insights emerge from our smallest missteps. Clayton Christensen. Section 6. Modern Examples of the Innovator's Dilemma. Technology and software, the AI revolution. The clearest modern mirror of Christensen's theory lies in artificial intelligence. For years, Established software giants like Microsoft, Google, and Adobe optimized sustaining innovations, making their existing products smarter, faster, and safer for enterprise clients. Then, startups like OpenAI, Anthropic, and Midjourney entered with tools that looked simplistic, chat interfaces, and image generators that made plenty of mistakes. Early on, their hallucinations and limited scope made them easy for incumbents to dismiss. But just as Christensen predicted, improvement came rapidly. Within a year, these tools began redefining how software itself is used. Suddenly, the big players had to react, integrating AI into their legacy products at high cost and speed. Parallel to the disk drive case, incumbents were focused on existing enterprise demands, while new entrants created a fresh market of individual creators and small business users. Lesson: even in tech's most advanced fields, disruption still begins with a tool that looks too simple to matter. Transportation, electric vehicles, and the auto industry. Few industries illustrate the dilemma better than automobiles. For a century, legacy manufacturers perfected the internal combustion engine through sustaining innovations. Better mileage, smoother rides, and incremental safety improvements. Then came Tesla, a tiny entrant founded in 2003, targeting a small niche of eco-minded luxury buyers. Early models were expensive, range-limited, and riddled with manufacturing delays. Traditional automakers scoffed. But Tesla's battery technology improved faster than expected, and it expanded down market with the Model 3 and Model Y. Meanwhile, governments and consumers began demanding sustainable transportation. The once small entrant became the new standard, forcing giants like GM and Volkswagen to pivot their entire strategies. Christensen's interpretation, Tesla exploited a new market disruption, starting with non-consumers who cared about sustainability rather than performance, then climbing into the mainstream. Lesson: technological paradigm shifts often begin as moral or cultural movements before they become profit movements. Entertainment and media, streaming versus traditional studios. Hollywood and television offer a textbook example of what happens when the value network shifts faster than incumbents can adapt. Traditional studios and cable networks once controlled every aspect of production and distribution. Then came Netflix, which started with a disruptive business model, DVDs by mail, and moved into streaming when technology caught up. At first, its quality was poor and its content library limited. The major studios viewed it as a niche service for movie buffs. Within a decade, streaming not only became mainstream, it became the dominant form of entertainment consumption. Now, legacy networks are scrambling to replicate the model, often at massive losses. Parallel to Christensen's retail example, cable networks are the department stores. Netflix and YouTube are the discounters who won by serving overlooked viewers. Lesson: disruption can emerge from a change in delivery model as much as a change in technology. Finance, fintech, and the banking sector. Banks represent one of the oldest and most heavily regulated industries on earth. For decades, they focused on sustaining innovations that improve profit margins, ATM efficiency, branch consolidation, mobile apps for existing clients. Meanwhile, fintech startups like Revolut, Cash App, and Chime entered through a different door, serving the underbanked young users and gig economy workers who were largely invisible to major banks. These apps were simple, cheap, and limited at first, but they offered something incumbents did not: accessibility and trust through transparency. As features grew to include loans, investments, and credit cards, traditional banks found themselves defending the high end while new entrants captured every young customer segment. Christensen's parallel: like mini mills in steel, fintech started with the least profitable customers and moved up market step by step. Lesson: disruption often thrives where regulation and legacy systems make experimentation too slow for incumbents. Gaming and cloud platforms. The gaming industry has been a laboratory for disruptive innovation for decades. Console manufacturers like Sony and Microsoft have perfected sustaining innovation: faster processors, better graphics, and premium hardware. Then came mobile gaming and later cloud gaming, services like GeForce Now or Xbox Cloud Gaming. At first, these games looked primitive and laggy, a toy compared to high-end systems. But for casual players and mobile users worldwide, good enough was more than enough. The convenience of playing anywhere outweighed graphics fidelity. Today, mobile games generate more revenue than consoles and PC combined. Christensen's interpretation: an entire industry overserved its hardcore audience and ignored the next billion players. Lesson: when technology reaches the good enough threshold, the market shifts from performance to accessibility. Education and online learning. Perhaps no sector better illustrates Christensen's long-term vision than education itself. He predicted that online learning would disrupt traditional universities in the same way that mini-computers disrupted mainframes. At first, massive open online courses, MOOCs, were dismissed as inferior substitutes, too impersonal, too basic, and lacking accreditation. But as platforms like Coursera, edX, and LinkedIn Learning improved their content and credentials, they found new markets: adult learners, professionals, and global students priced out of traditional college. Today, hybrid learning and AI-driven tutoring are forcing universities to adapt their models, rethink pricing, and experiment with flexible programs. Lesson: disruption thrives whenever a new delivery model expands access to something once reserved for a few. Connecting modern disruption back to Christensen. Across these industries, AI, transportation, media, finance, gaming, and education, the same sequence unfolds. 1. Simpler entrants target overlooked or underserved users. 2. Incumbents dismiss them because early performance is low. 3. Entrants improve faster than expected. 4. The market redefines value. 5. The old leaders scramble to catch up. Christensen famously said, "Disruption is a process, not an event. It doesn't happen overnight, but when it hits critical mass, the shift feels instantaneous." Section 7. Lessons for Business Students. Why this book belongs in every business curriculum. Christensen didn't write The Innovator's Dilemma only for the C-suite. He wrote it for the leaders still learning how to think. For business students, the book is more than a theory. It's a lens for interpreting change. It teaches that strategy isn't just about spreadsheets or market share. It's about seeing invisible forces, technological shifts, customer overshoot, and cultural inertia that data alone can't show. When you understand disruption, you stop judging companies by how smart they are and start evaluating how adaptable they are. That mindset is what separates managers who defend the present from innovators who shape the future. Lesson 1. Adopt a dual perspective sustaining and disruptive. Every great leader must hold two opposing ideas at once. 1. Sustain today's success. 2. Build tomorrow's replacement. Christensen called this ambidextrous leadership. It means managing sustaining innovations, those that improve existing products while simultaneously nurturing disruptive ones that might cannibalize them. For students, practice toggling between these lenses. When you study a company, ask, what are they improving for current customers? What might make their core product obsolete? This habit forces strategic thinking beyond incremental change. Lesson 2. Redefine failure as data. Business schools often reward perfect plans. Christensen's work teaches the opposite. The world rarely behaves according to your plan. A failed product, pilot, or forecast is not an error. It's a measurement. For your future projects, treat every outcome as a data point. If you test a marketing idea and it flops, document why. You've just paid tuition for knowledge your competitors don't have yet. Each misstep reveals a boundary of what customers value. Christensen, the leaders who thrive are those who record, share, and build on those lessons instead of hiding them. Lesson 3. Understand value networks, not just markets. A value network defines how a company creates and captures value. When disruption hits, the network itself changes. New suppliers, platforms, and pricing norms emerge. Example, Uber didn't simply take market share from taxis. It rewired the entire value network of urban transport, shifting from licensing and ownership to data and availability. For students, when analyzing a case, map the entire system, the ecosystem of partners, regulations, and customers, and ask, what happens if this network shifts? That's where disruption often hides. Lesson 4. Watch for performance overshoot. Christensen's research shows that industries often collapse not because technology slows down, but because customer demand plateaus. In class, we often learn to compete by being better, faster, or more advanced. But the key is knowing when better stops mattering. When laptops got faster than users needed, smartphones took over. When cameras became too advanced for casual photographers, phones absorbed them. For future managers, track customer outcomes, not just performance specs. Overserved customers are red flags that change is coming. Lesson 5. Measure learning alongside profit. Traditional success metrics, ROI, NPV, margin, favor short-term certainty. But disruption rewards long-term discovery. Christensen urged leaders to develop learning metrics, speed of iteration, number of experiments, cost per insight. Imagine grading a startup not by its quarterly profit, but by how fast it uncovers what customers actually want. That's the future of management education. For students, begin now. When working on class projects, add one column to your reports. What did we learn that we didn't know before? Lesson 6. Be willing to cannibalize your own ideas. Christensen's famous challenge: if you don't disrupt yourself, someone else will. For future entrepreneurs, that means releasing a version 2.0, even if version 1 is still selling. For managers, it means investing in the next technology before your current one peaks. Case study reflection. Apple released the iPhone knowing it would destroy iPod sales. That self-cannibalization created a $1 trillion product. Kodak, fearing lost film revenue, avoided digital and collapsed. Ask yourself, would I have had the courage to make that decision? Lesson 7. Think in experiments, not certainties. Christensen taught that innovation is a process of discovery, not prediction. Instead of asking, "Will this idea work?" ask, "What can we test next to learn whether it could?" For future leaders, this mindset shifts culture from "prove me right" to "show me what we learned." When you leave school and start leading teams, the best thing you can say after a failure is, "That was valuable. Let's adjust and try again." Lesson 8. Apply disruption ethically. In his later years, Christensen reminded us that innovation carries responsibility. New technologies don't just disrupt industries, they disrupt people's lives and livelihoods. He urged future leaders to pair creativity with compassion. The purpose of management is not simply to make money, it's to build people and organizations that endure. For business students, this means pursuing innovation that creates constructive disruption, solutions that expand opportunity rather than replace it. AI, automation, and new business models will test your generation's ethics as much as its intelligence. Lesson 9. Lifelong learning and adaptability. Finally, Christensen's ultimate message to students is humility. Even the best theories eventually meet their own innovator's dilemma. The leaders who endure are the ones who keep learning, unlearning, and relearning. In a world where industries evolve faster than degrees, your real edge won't be your GPA. It'll be your capacity to stay curious. Disruption favors the student who never stops being a student. Pulling it together, a playbook for future leaders. Let's summarize the playbook for your career. 1. See change early by watching overserved customers. 2. Protect space for experimentation. 3. Measure learning, not just earnings. 4. Challenge your own success models. 5. Build ethically. Innovate with empathy. 6. Keep a learner's mindset. These 6 habits turn Christensen's theory into daily practice. They transform innovation from a buzzword into a disciplined way of thinking. In his final lectures at Harvard, Christensen often asked his students a simple question: when you're successful, how will you measure your life? It's the same question you should ask of your career. Will you measure it by promotions and profit margins, or by how well you adapted, learned, and helped others grow? That, in essence, is the true legacy of the innovator's dilemma. Not just understanding disruption, but using it to build a meaningful, sustainable future. Section 8. Quick Glossary Recap. Here's your Innovator's Dilemma cheat sheet. Memorize these for exams or case analyses. Disruptive innovation, sustaining innovation, performance trajectory, overshoot, overserved customers, value network, low-end disruption, new market disruption, technology, S-curve, the innovator's dilemma, cannibalization, incumbent versus entrant, resource dependence, fail small, fail often. These are your building blocks for analyzing any disruption story. Section 9. Conclusion. Seeing the future before it arrives. Over the course of this video, we've explored the paradox at the heart of modern business, how success plants the seeds of failure. Christensen showed that good management, customer focus, and efficient execution, the very things business schools teach as virtues, can trap organizations in yesterday's logic. Disruption isn't a thunderbolt, it's a tide. It starts small, quietly filling spaces no one else bothers to serve. By the time it crests, the landscape has already changed. The true lesson of the innovator's dilemma isn't only about technology or competition. It's about vision. Vision is not predicting the future, it's recognizing weak signals of change in the present. A visionary manager looks at a crude new product and doesn't laugh. They lean in. They ask, who might this be good enough for today? And how fast could it improve tomorrow? Christensen reminds us that the most powerful question a leader can ask is, what if our assumptions are wrong? That single question has saved more companies than any spreadsheet ever built. How to lead in a world of disruption. For future leaders, the book offers 3 enduring practices. 1. Learn constantly. Make curiosity your default operating system. Treat every failed project as a data point that narrows uncertainty. 2. Balance dual horizons. Protect the core business, but explore the edges. Build small teams with the freedom to think differently, even if it means competing with your own success. 3. Measure learning, not just profit. Ask, what do we know today that we didn't know last quarter? Progress is the expansion of understanding, not only the expansion of margin. These habits transform disruption from a threat into a strategy. Why the dilemma never goes away. Every generation believes it's immune to the innovator's dilemma. Managers in the 1960s said disk drives were unique. CEOs in the 1980s said retail was too mature to change. Tech leaders in the 2000s said their networks were too entrenched to fail. Today, we hear the same confidence in AI, streaming, and electric vehicles. But the pattern never dies. It simply finds new industries to inhabit. That's the genius of Christensen's insight. It's not a business theory, it's a law of adaptation. The moment an organization optimizes for one model of success, it becomes vulnerable to the next. The processes that make you strong today are the same ones that make you inflexible tomorrow. Clayton M. Christensen. From Innovation to Integrity. In his later work, especially How Will You Measure Your Life?, Christensen connected innovation to integrity. He asked his students not only to change industries, but to change the meaning of success. Innovation without ethics is disruption without direction. Real progress happens when we use new ideas to make life better for others, not merely more efficient for ourselves. Management, he said, is the most noble profession, if it's practiced well. For you, as a business student, that means pairing ambition with empathy. Build products that solve problems worth solving. Create companies that outlive trends. Lead in a way that people are proud to follow. The final challenge. So, how do you measure your own journey from here? When you graduate, you'll enter a world defined by accelerating change. AI will reshape creative work, sustainability will redefine manufacturing, and data will rewrite marketing. The question is not whether disruption will reach your field. It's how prepared you'll be when it does. Remember what Christensen taught. The next revolution always looks small at first. The next great company often starts with a toy. And the next leader is the one willing to listen when others dismiss an idea as impossible. Be that leader. Keep one eye on today's customers and the other on tomorrow's possibilities. Stay humble enough to test, curious enough to learn, and brave enough to disrupt yourself before the world does it for you. Let's end where Christensen often ended his lectures, with perspective. In the final years of his life, he told his students that business theory, like technology, is temporary. It works until it doesn't. What lasts is character, the commitment to learning, adapting, and leading with purpose. Decide now what you stand for, he said, so that when the winds of change blow, you'll know which way to lean. That's the legacy of the innovator's dilemma. Not fear of failure, but faith in growth. Not worship of profit, but pursuit of progress. If you carry those lessons forward, if you keep learning, questioning, and building with integrity, then you'll not only survive disruption, you'll lead it. Thank you for joining me on this deep dive into the innovator's dilemma. If this helped you see business differently, consider sharing it with a friend, a classmate, or a future leader who might need it. And remember, the next great innovation might be sitting quietly on someone's desk right now, maybe even yours.